So today we've got an awesome guest joining us on the Wise Wealth podcast. Really excited to get stuck into the discussion around the markets and the current outlook. I'd like to introduce you to Alex. Alex, if you can tell everybody on Wise Wealth a little bit more about yourself and your background, please.
Yeah, hi Sam. Thanks for your time today and invite me on the podcast. So I'm Alex Brandreth. I'm the Chief Investment Officer at Luna. Before talk about Luna, just explain kind of maybe a bit about my career, if that's all right, Sam. So
Yeah.
so I was quite lucky actually. I joined the industry kind of 2005. So before the financial crisis started, and got stuck in at a financial advisory firm and was doing fund research. So I worked there for a number of years, and then went to join a national discretionary wealth manager, Brown Shipley. And I was there for 10 years and joined as a fund analyst and left as deputy CIO, and even had a brief stint as chief investment officer when I was there. And that really kind of helped cement my kind of industry knowledge and what I wanted to do within the industry. And then we made the decision in late 2019, early 2020 to start Luna. Great timing from a global pandemic perspective. But yeah, we decided that we wanted to start our own discretionary manager, and that's what we did. So we started Luna in 2020, and now we're the fastest growing, biggest discretionary independent wealth manager in the Northwest. So managing just over 700 million. So growing very quickly in a very short period of time.
I suppose on that side of things, just what massive congratulations on achieving that, and more importantly, how on earth why are you the fastest growing? Like, what are you doing that's different? I mean, achieving 700 million in that space of time's pretty quick turnaround. What is it that you're doing differently from other firms?
Oh, well, thank you. To begin with, what we do differently, I think the first thing is we've got a really good team. So there's a team of about 15 of us who have all got a lot of grey hair. So we've all worked in the industry for a very long period of time. We've worked with introducers, worked with clients for a long period of time. And over that, when you do work with people for a long period of time, you just gain trust. Trust is one of the most important things in this industry. When we're researching or investing in any product, we've got to trust that the investment manager is going to do, or the fund manager is going to do the best things on behalf of our clients. So I think that's the most important thing. Trust, experience, and communication. I mean, the last few years has been very volatile. We've had periods of, well, we've gone through a pandemic. We've had periods of high inflation. We've had interest rates moving. You've had big shocks in both the bond market and the equity market. And you just need to communicate and keep people updated all the time with what you're thinking and why you're positioned. And we spend a lot of time on that side as well. So all of those things together, a good team, working hard, having the trust of your clients, and communicating well, and then ultimately, delivering good long-term performance to clients has been what's been testament to it.
Yeah, I think, to be honest with you, having that time from 2020, did you start investing after the drop on the indices, or was it before? I mean, that's a big start in how your performance track record goes, eh?
It is. I mean, so I joined Luna in February 2020, so just on 4 years now.
Okay.
But the first few months of setting up the business, and weirdly, in that first lockdown, it was great because we just started up a business and we needed to get a website up and running. We needed to get systems up and running. We needed to get forms in place, processes in place, etc. So we didn't actually start investing until June. So the market low was the 25th of March, was it? So
Yeah,
we missed it by about 2 and a bit months, and then so we were quite lucky from that perspective that we were starting just as the market has started to bounce, and then obviously you had the Pfizer day in November, which really the market took off, and then you could really start to see light at the end of the COVID tunnel.
Oh, well, to be honest, you couldn't have really asked for a better starting point, could you? I mean, that sort of timing as well, just dodging that side. Obviously, investors got to get used to volatility in the future, but I mean, it's a great point to start just on pretty much the start of a bull run and get the uplifting of that. So, I mean, amazing story and congratulations on what you've achieved. So let's talk about the markets. I mean, what's your current thoughts around the markets where we're at this moment in time? And yeah, it'd be great to discuss that further.
Yeah, I think we're pretty optimistic and across the board really, because we're looking at returns from asset classes from here looking forward, and the starting valuation, which is always the most important thing whenever you invest in, is pretty attractive. So for the last 15 years, we've had zero interest rates, which means bonds have pretty much had very low returns. But now we've got normalized interest rates or slightly high interest rates. We're looking forward thinking we can deliver pretty attractive returns for bond portfolios. And there's parts of the equity market that look pretty stretched. But on the whole, equity valuations are pretty reasonable as well. And as you said, the market is in pretty positive sentiment at the moment. You wouldn't think it when you look at the press or anything, but we had a strong bounce to the end of 2023. This year, I can't count how many times the S&P 500 has hit record highs, but it's maybe 5 or 6 now. So again, it's you're seeing pretty positive signs from the market in general. Away from the US, I mean, there's parts of the US that look pretty stretched, but away from the US, most equity markets look pretty reasonable. So you're putting all that together, we always say for kind of a medium risk portfolio, 6 or 7% is probably expected over the long term. You never get 6 or 7% in a single year. But now with bonds, investment grade bonds, it's yielding 6 or 7, high yield at 7 or 8, and decent equity valuations. You could probably say instead of 6 or 7, you maybe get 7 or 8 at the long term. And the key component to that is interest rates and where they are today, because that helps other asset classes deliver, well, they have to deliver higher returns to compensate for the risk for being invested.
Yeah. Yeah, it's very interesting. I think, I was reading about the other day about that. I'm not sure if it was European or UK equities, but they're the cheapest. They're the most distance in valuation from the US. So they're the cheapest they've been in correlation to US equities. Do you feel that there's sort of like an underlying opportunity here, more so leaning towards UK and Europe than the US? It's something that I've been talking about quite a bit with different investors and traders, and I think from my understanding, we're seeing a lot more attractive PE ratios in the UK over the US. Do you have any sort of thought on that side of things?
Yeah, so I think it's something we've been talking about for a while, and the UK does definitely stand out like cheap. And you're absolutely right. The UK market trades at a discount to the US. And if you go even further, small and mid cap trade at a discount to larger companies as well, principally because they're more exposed to the UK economy and the concerns about what's going on in the economy at the moment. So there's definitely a discount. Valuation works very well over the long term, but things can stay cheap or expensive for a long time until they correct. And you have to look at the reasons behind it. The UK has been going through political turmoil now since Brexit. We haven't had any political stability for a long period of time. I think there's potentially some issues with regard to UK listings as well. There's the amount of companies that are moving listings from the UK or choosing not to list in the UK relative to the US is definitely extrapolating the problem. Where if you look at ARM or CRH recently decided to move from the UK to the US because they were trading so cheap. And I suppose the other side to it as well is, so the UK is cheap, but why is the US expensive? And the US is expensive because the companies are growing. I mean, the strong earnings growth that you're seeing coming through. I mean, Meta last week announced their first dividend, and the shares were up 15% on the day. So look, so things can trade cheap or expensive for a long period of time, but it's growth what equity investors want. And then within the US at the moment, you're certainly getting that because of the strong backdrop and the high quality companies that you have over there with very strong margins as well. And you sprinkle a little bit of artificial intelligence on top, and everyone's getting very excited.
Yeah, it's a shame, isn't it? Because I think honestly, the political side in the UK is ultimately what's letting us down. And I think, with you said obviously this year actually looks quite positive. You said, Do you foresee sort of like UK, US elections as a big risk to the performance of this year?
Yeah, something we've been talking about with clients is and it was part of our 2024 outlook is the political backdrop because you've got half the world's population going to the polls this year. So I think there's a lot of attention on the UK and US, but you've already had big elections in Taiwan, for example, and big elections in India to come this year as well, which is just going to be equally as important in terms of the emerging market story.
Yeah.
Um, so politics can cause short-term volatility, and we've been looking at quite a lot of what's happened in history around different election results, etc. And what you tend to see is markets don't like uncertainty. So for the 2 or 3 months maybe before the election, and we obviously don't know when the UK one's going to be yet, but it's going to be towards the autumn, we would imagine. You get that period of uncertainty about who's going to come into power. I think within the UK, there's not really a lot that either party can do, and they're quite centralist in their views anyway. Because, and as I said, they can't do a lot because they've got how much debt that we have to deal with. So I don't think the UK election will cause too much volatility. After the election, you have the certainty of the event, and markets tend to rally off that. Within the US, I think it's even more difficult to call because you still don't know who's going to be running. And let's just go for a case of Trump because everyone
Yeah.
likes talking about Donald Trump.
Yeah.
When he was in power last time, you couldn't call it either because the first couple of years he was very pro-market, very pro-US economy, and the markets had a very strong period. And then the trade war with China kicked off, and that
Yeah.
caused global markets to be really under pressure. So even with someone like Trump, you couldn't call which way it was going to be. And then I suppose back to what I said right at the beginning, we're long-term investors, and this is going to cause a lot of short-term noise, which will always presents opportunities. But really, we've looked at the history of different parties being in charge in the US and how that impacts economic growth and stock markets. And there's no strong correlation, really. You can have Republicans or Democrats in charge, and it doesn't really impact the markets on any single year or the economy, really.
Yeah, I was looking at the same thing with different presidents to look at, correlation between Republican, Democratic sort of led parties and how that changes the performance in that time during the stock market. To be honest with you, if you don't like Democrats, Barack Obama had a great run in the stock market side of things. So
Yeah,
yeah, I don't think there is pretty much no correlation there. But I mean, he's already sort of highlighted Donald Trump, hasn't he, at the fact that he's going to come back onto that trade war, so to speak, with China. So I suppose it highlights that risk again initially.
true.
But yeah, it's a catch-22, isn't it? Because from a political sort of stability perspective, he might actually bring stability in this crazy sort of war conflict area that we're in at this moment in time over someone like Biden. But yeah, it's going to be an interesting time, that's for sure. And hopefully he does go down. I think personally he'll get in. What do you think?
I don't know. I think probably. I mean, you just look at the news every single day, and it just definitely looks like it's going that way. But I've got no great view on the US election cycle.
Yeah.
I won't be able to call it.
Yeah, it's a tough one. It's so crazy to watch as well. It just seems like the more court cases he gets against him, the more sort of airtime that he gets and the more sort of pushing he gets as well. Very crazy times from a political perspective. But yeah, it feels like from the market's perspective that AI has definitely hit sort of America and their markets a lot more so than here. Obviously, rightly so because they have a lot of the biggest tech companies there. But it feels like we're really lagging on that side of having big companies step up that are implementing AI. And my followers probably hate the fact that I carry on talking about this, but
Hmm.
there's a big company that I'm invested in at this moment in time called Future PLC, and it's like 1 in 3 people in the UK and US read their content as a publisher, and you just sit there and think, you guys are sat there right on the cusp of just introduce AI into writing. 1 in 3 people in the UK and US read your articles. Surely you could save an operational cost or have some sort or performance boost by just mentioning we're implementing AI. And it just feels like the UK is lacking that sort of push to actually get behind that and drive it. But yeah, maybe it's a bit of a bitter one for me, but I think
Yeah,
it's
I think you're definitely right there, Sam. I mean, like, I think the initial winners, everyone's going to look at the large tech names. I don't think we've figured out who the winners are going to be from AI, full stop, though. Nvidia is seen as the champion because of the fact that they develop the chips. But who else is going to win? There's some brilliant businesses listed in the UK. I think Relics is probably another good example, and London Stock Exchange and companies like that, where they are taking advantage of AI. It's just not maybe thought about as highly as and as obviously as those companies. And I don't know Future too well, but maybe it's in that camp as well, where they are good businesses that are going to develop and win over the long term. It's just not being recognised by the market right now.
yeah. Yeah, it's true. I do feel that. I was doing some research on it as well from an opportunities perspective in the UK. From a small cap perspective, it was also one of the lowest value points that we were at in their valuation. And I think it was only a few months after that I did that research, JP Morgan then came out and said that they see opportunities within the small cap. Have you had any thought about that side of things?
Yeah, we've got within our UK positioning, and to be honest, US as well now, and globally, we do have a bit of a small cap bias at the moment. The valuations there are pretty attractive. Large cap has done so well in the US and UK, so you're looking at where the S&P is, but the Russell 2000 below it is nowhere near touching all-time highs, and FTSE small caps lagged because it's been a tough couple of years for those businesses. So there's definitely opportunities there, and but the flip side of that is you've got to expect volatility. These are smaller businesses, so they're going to be more volatile, and liquidity is not as strong in that part of the market. So you've just got to be patient and willing to take a long-term view. I suppose the other area which kind of highlights that is we do quite a lot of work in investment trusts.
Okay.
And part of the reason we wanted to set up Luna is you're seeing so many national discretionary managers kind of starting to centralize their investment approach. And within that, you start to have big, large, open-ended funds. You can't really invest in investment trusts because of the liquidity and dealing in them. So we, as a relatively large now, as we touched on, but as a new discretionary manager, we wanted to have that within our approach because fundamentally, we think they can add good value to client portfolios and deliver good performance over time. And in investment trusts, the discounts available on them now are so attractive compared to what you could buy an open-ended fund at. But again, the liquidity is not really there. So it's just to us, it just presents an opportunity at the moment within a part of the market which is maybe not looked at as much as it should do. But there's some really good opportunities there.
I think for those listening, can you explain a little bit more about what is an investment trust, so that maybe those that don't understand know a little bit more about it?
Yeah, of course. So an investment trust is a bit like a fund. So it's a collective vehicle, invests in lots of different companies. But the difference is it's traded on the stock market, whereas an open-ended fund is they cancel or create shares every single day. So it's daily dealt. But with an investment trust, because it's got a limited amount of shares that have been created and it's traded every single day, it means that you've got the net asset value that it's traded at, which is the value of the portfolio, but then also the market cap, which is based off the share price. So the share price can trade at a premium or discount to the value of the company value, to the net asset value. So at the moment, as I was touching on, quite a lot of these investment trusts are trading very significant discounts to what they're actually worth. So, for example, there's a company we buy called Pershing Square. And Pershing Square is managed by Bill Ackman, has been for a very long period of time. It's in the FTSE 100. It's an investment trust, and it buys US companies fundamentally. And it's currently trading at a 28% discount to its value. So it's worth £100 today, but we're picking it up at kind of 72 pounds. So just to highlight the value there, and the performance from that trust has just been staggering for a very long period of time.
Why do you think it is trading at discount?
Good question. So it's trading at a discount because it had a very public spat a couple of years ago with one company. I'm just trying to remember what it's called now. did Herbalife. He had a very public spat with Herbalife, and Herbalife share price kept going up, and he was short.
Oh, yeah.
So that impacted the kind of perception of the trust. So I think that was the first thing. I think the second thing is then once you trade at a discount, you always tend to trade at a discount. It's very hard to close. And it's been this wide for a long period of time. The trust are looking to make some changes, so they're buying back their shares. So there's an actual buyer within the market, but that's not really helped too much. And I think the other thing as well is that that one particularly is focused on the US, and he's a US investor, and they can't promote the trust because it's listed in the UK to US investors. So I think there's probably a little bit of an issue there. They are looking at changing that. So I know that they're looking at trying to see if they can list the product in the US, which could help close the discount. But to be honest, though, it's a very good question because I scratch my head every single day about that, because I look at the performance and I can't remember what it did last year, maybe 20% last year, 20% the year before, etc. And you just wonder, why are you trading at such a wide discount? The performance has been excellent. The issues that they've had in the past have gone. They've changed they're not sure Herbalife, and they're not being as public with those issues in the future. So no, it does confuse me, which is why I hold a PA.
Yeah. I think he's like turned his attention now, hasn't he, to be focused on Business Insider or something like that. That's the latest I've seen, some sort of war against Business Insider and trying to pull them apart. So he always seems to be that sort of character, doesn't he, to be going after someone or something. But it's very interesting. Similar thing that I was looking at was a company called Sentiment PLC, miner, and they sat on so much in gold storage, and it was trading at discount from the amount of gold they actually had in storage. And I saw gold prices going up, and I'm wondering, why are you trading at such large discount when you have this amount of gold in storage? But yeah, it's always a bit mind-boggling when you're wondering why are they? But that's where the opportunity is, I suppose, ultimately, isn't it?
Absolutely. And I think just on that point, Sam, I mean, Japan was one of the best performing markets last year. And the reason why Japan did so well is the regulatory change that's coming through. And Japanese businesses, is kind of on that point, have always sat on a lot of cash. And Japanese interest rates have been kept very low for a long period of time, which has impacted the profitability and the returns that those businesses have been able to generate. But the regulatory change that's come through to make businesses more efficient, to start to hand back that cash to shareholders or be more efficient in what they do, really drove the market. So sometimes you can just be sat there, and I know where these issues just get resolved and they sort themselves out. Sorry, the only other thing I was going to say with Pershing Square is maybe the fact that, as I said, more investors are moving away from buying investment trusts probably hasn't helped them. And it's also quite expensive, and the cost disclosures that we as wealth managers have to do to clients nowadays probably highlights that it's pretty expensive. But what we always say to clients is, well, the fees that you're paying are after the performance. So if it's delivering performance and it's consistent in what it does, then it's reassuringly expensive. But I think there's definitely a bit element of that within the industry at the moment, where people are starting to shy away from more expensive things because they have to report it. And I just think that's wrong, to be honest.
Yeah. No, it's all very interesting. In regards to the sort of Japanese economy, obviously, I think it's the end of H1, they're sort of expecting to start increasing their interest rates. How do you think that will affect, I suppose, both their currency and the stock market as well?
It'll be interesting because it's going to be at a time where everywhere else is probably going to be cutting rates. So the UK and US and the ECB really want to be cutting. I'd say probably sooner rather than later. Now, the US data come out recently has been very strong, but you've got to suggest that's going to be favourable for the Japanese currency because it's going to get relatively more attractive after a period where it's had a very tough time because of the fact that the Japanese central bank haven't been increasing interest rates. I don't think that the JCB are going to do a lot, though. I think it's going to be at the margin. I think what you'll see bigger cuts coming out of the developed markets, the Western world, and the Japanese market will be increasing. But I mean, it's certainly interesting, and it's going to have a big impact on any company which is exposed to the exchange rate to a certain extent. So, well, to be seen really.
Yeah. And do you sort of anticipate, like, if you're looking at the currency, sort of like US dollar against the Japanese yen, obviously, we're looking at US dollar cutting rates, yen increasing rates. Do you see US dollar weakness against the yen when that starts happening?
Yes and no, to be honest. I'm not a great currency forecaster, and I don't think I've ever met anyone who is. I think we've looked at currency funds in the past, and half the time they outperform, half the time they underperform. So I'm not sure that anyone can get currencies spot on, because there's much other driving factors going on within the market anyway. But I think what we're talking about is very expected by the market as well. I think so there's certainly an element of that being priced into currency exchange rate already. But it really depends on what happens in the future. Are the JCB going to keep increasing interest rates materially over the next few years? And then that's going to be the key driver to be supportive of the yen.
Yeah. Yeah, it's very, very interesting points. Very interesting points. Anything on commodities? Do you have any focus around commodities and that side of things? I mean, I was looking at it the other day and it was just like orange juice has been on an absolute, absolute roller coaster to the upside. I've never seen orange juice been absolutely flying the way it has been.
We don't do a lot in commodities really. I mean, we buy some of the big oil majors because
Okay.
we're quite constructive on that asset class. I think from a and the miners to a certain extent, because there's been so much underinvestment over the last 5 years or so, because the businesses haven't been able to get new projects on stream because it's been, against the ESG bandwagon that most governments have been looking after. So you've not had big projects come on, and demand is not going away, whether it's for oil or other commodities. We talk about going to this electrifying world, but that takes raw commodities out of the ground to be able to do that and to make it work. So we think just from that supply demand imbalance that there's definitely opportunities in commodities. I hadn't seen the orange juice price. I'm not sure what's driven that. Maybe a bad
I think
winter or
it's
something like that.
Yeah, I think the main places where orange juice is from, so I think Florida, Mexico, and I think it's either been droughts or it's been flooding. So it's been bad bits. Yeah, it's up like hundreds of percentages over the last couple of years. It's just it's been going absolutely crazy. It's really interesting you say that because I took on some exposure to oil services and equipment ETF because I just sort of wanted some sort of exposure to that market that wasn't specifically behind oil prices, but
Mm.
more of like equipment, drilling, and that side of things. And I suppose my biggest ETF for 2024 that I was looking at is relatively new actually. It listed in the US called Shield, SHLD, and it's specifically invests into military defense companies, just because I think that this year's not going to be shy of more conflicts, I don't think, or defense spending with. And I sort of based that off of the US spending bill to increase by 40% this year. And I thought, well, if it's going to go somewhere, it's probably going into the military defense.
No, I mean, yeah, I think the last few years have been the anti-ESG kind of years when you think about it. You touched on military and kind of weapons and things like that. They're obviously doing very well. Oil and gas are doing very well. Banks do better with interest rates going up. So it is kind of weird that we've spent maybe 10 years talking about ESG within portfolios, and you can do well for the environment, etc., and you can make money. And it feels like the last few years it's kind of gone against that. And it's been interesting that you started to see people's views and strengths of views start to waver on it as well.
Yeah.
So which is wrong because it's people's trust in that sector is going to a certain extent because people starting to be compromised with their views.
Yeah, no, I agree. I think that side's definitely even stuff like cybersecurity is on the up with everything that's been going on. But when we start looking at the sort of going electric, so to speak, that's sort of just really taken, I would say even more so this last month. We've seen I think it was Ford, they literally shut down their entire EV development for electric vehicles going forward. And then we saw Hertz, they cut virtually every single EV order and I think sold something like 20% of their entire fleet. So it's like the demand there looks like it's really is struggling. And I mean, look, Tesla's always been very on the run, but at this moment in time, it's like I think one of the worst performers, I think, out of the large caps in the US, especially for January. I think it was last time I looked, it was at like $170 or something.
Yeah, I mean, I think to me, what it all comes down to is just the cost. Because it's expensive enough buying a car. It's probably the second most expensive thing you buy after a house, and
Yeah.
these vehicles aren't cheap. I've been thinking about it myself. When do you go to an EV, and it's just very difficult to justify. And I think maybe a few years ago it was different when electricity prices were lower, but obviously that's changed a lot over the last few years as well. So I think it's a lot more of a level playing field, and people are just going to go for unfortunately, the cheaper option, which is maybe not the best for the environment.
Yeah. Yeah. Yeah, it's a tough one, isn't it? And I wonder how that market sort of recovers, unless there's some more government grants that come around that
Yeah,
side of things to sort of encourage that space. But it seems, yeah, it seems like a risky area for exposure. It's a shame, isn't it? Because, the whole agenda was pushing this side of things, and like you said, it looks like it's completely reversed.
yeah, no, I think so. And sorry, the other big factor is obviously the range as well. I mean, I don't know about yourself, but when I'm driving, I don't want to be panicking about running out of petrol or
Yeah.
how far I can drive. And I think the range is definitely getting better on these cars, but there's still a long way to go. And yeah, I think if I was running out of petrol, I'd rather pull over and fill up and do that within 5 minutes and sat in a car park for half an hour while your car charges. I think so. We'll wait and see. But I
Yeah.
mean, I'm just too old and cynical nowadays.
No, I don't think so. I think some of the stories that I've heard is like people pull over to charge them up. They find where there is like a supercharger, fast speed one on the motorway, and then they get there and there's two cars already in front of them. So they've actually got an hour wait before they can even then go and plug in, because usually there's like two or three, but they're all broken. There's just one that's working. So it's just like typical that they're sat there then for an hour. And I think, it takes a lot more time to plan their journey than what it would do with the ease of just driving in petrol. I think EV works around London because there's obviously incentives for parking and that side of things of going into different zones. But I think outside of London, I don't think it's practical at this moment in time. But hopefully it
Mm.
changes in the future. We'll see.
Yeah, but you're right. It's the infrastructure that's crucial there, isn't it? And having a good infrastructure rollout throughout the globe, not just the UK, is what's critical there.
Yeah, yeah, it's very true. Honestly, I think we've covered so much in this podcast, and just really appreciate your time and coming on and sharing your outlook and what you're up to. I think it's absolutely fantastic. For everybody listening that would like to find out more about you, about your business, what's the best way to find you?
Yeah, well, thanks, Sam, and thank you for inviting me on. It's been really good to chat with you as well. So we've got a website like every firm. So it's lunaim.com. The contact us page is on there. We're all on LinkedIn and things like that as well. So if anyone wants to connect on there, please feel free. And we do write a lot of news and insight pieces as well. So there's a news and insight piece on the website which has our outlook and our different views as well. And so if anyone's interested in learning more about us, please feel free to reach out or to read some more on the website.
Awesome. Thank you so much. Honestly, it's been a pleasure.
Thanks, Sam. Appreciate your time.